the mid to late 90s, there have been some losses which have happened against some of these triple V assets, some of these A minus kind of assets. And people have memories of those assets. Though if you really look at the performance of a lot of A-rated companies today, is far superior to those that was there. The reality is that investors have experienced some of that. I think those memories are slowly fading away and people are coming. Today you see credit opportunities funds which are of fairly material size building up and trying to look at a variety of products. And I think this is really an exciting new space which is opening up pretty materially. Today people are trying to do all kinds of structured trades, and I think alternate investment funds in small measure are coming into these kind of markets, specialized NBFCs, specialized real estate finance. Some of these segments are trying to enter the market, which I think is a big positive. And I think that's going to be interesting times in terms of how we are going to bring credit specialization into the whole fixed income space. So that's a new area which I think will develop over the next few years.
Actually, I have a long list of questions, but maybe let me ask one last question, which anybody would want to take it. Does India have a need for hedge funds? Are they a solution for any of the problems which we are discussing? Whoever wants to take it.
See, I guess our problems are much more structural in nature in that sense. You are talking about a specific market participant here and its behavior under various market circumstances. So I think one of the points that Dhawal was mentioning that, if you have your house in order, you can absorb all different kind of flows, right? So once we put our house in order and once we are much more sure about handling ourselves properly, it does not really matter as to the color of the money. Money is all the same as long as you are absorbing it in the right manner. So whether it is a sovereign wealth fund putting in money, a hedge fund looking at specific assets into India, and hedge funds also have a very important role to play as far as risk appetite and risk capital is concerned, and every economy including India would need it from time to time. So it's not a straight yes or no to different type of investors. It's just that you need to be that strong as an economy and as a financial system to absorb these kind of flows from time to time. So I think it's a very there is no yes or no kind of an answer to hedge fund money into India. It's more to do with your own standing as far as the health of a financial system is concerned.
Even though we are short of time, but maybe we can take one or two questions.
I have this question to Sujoy. We touched about the point that maybe Japanese investors are the next line of investors who can bring foreign investments in this country. The key question that I had, and I raised it in an earlier session as well, was that today when I raise money in the market and I deal with FIIs and domestic mutual funds as well, I see that the cost of fund coming from the domestic market is far cheaper for me than borrowing it from abroad because of the hedging costs which come into play. These investors per se, therefore they have a higher expectation from a yield perspective and therefore they become unviable. So how do you take care of that element and how do you make sure that then this money stays and it's become viable for people to borrow domestic?
True, actually. So that's one big deterrent. So while if you look the way the currency has been for the previous 1 year, it has been largely stable around the 60, 62 band, and in fact probably it has appreciated from those 70 levels to these levels. But the forwards have actually not come off, and forwards have been pretty sticky. So that's a challenge. I think the forwards will continue to be sticky around this 7%, 7.5% level as long as inflation is high. And people will have deep down in their minds have an opinion that Indian currency can continue to depreciate as long as inflation is high or the differential inflation between the trading partner is high. So I think the biggest challenge to attract foreign money and so as you can borrow abroad, invest in India in a far more meaningful manner with a lower hedging cost, I think the fundamental position to take is to get your house to order so that you bring down your inflation so that eventually forwards will also come off. So that's, I think the direction is absolutely perfect right now, both government and RBI.
I got one more question. Can I ask Rajeev?
Sure.
Yeah, and first, thank you very much. You have moderated the session very well, really. Yeah. This question is to Amit. Now we talked about the length, the breadth, the liquidity. Another element which we see in the mutual fund industry today is the tenor. We really don't find long-term tenor paper coming. So if if a housing finance company is looking for borrowing from the debt market, we don't find that kind of money coming in. So the option that we have is we go off to the banks and we still have the challenge of ALM mismatches. So how do you want to address those kinds of monies, and how can we get long-term money?
Well, see, I understand where you're coming from. The fact of the matter is that the structure of the market always was such that within the capital market space, if you look at various types of investors, you have to essentially segregate investors who are looking to or who have credit risk appetite, and there is another set of investors who have duration risk appetite. So if you talk about, for example, pension funds or provident funds, PFs, EPFO, etc. Those are guys who actually have long duration money available with them, but they are not in a position to take credit risk because of the regulatory framework in which they operate. The other set of guys is people like mutual funds, even investment NBFCs, etc., who have the credit risk appetite, but they don't have a very good view in terms of their liability profile as to how long this liability profile is going to stay. The good thing, for right or wrong reasons, that has happened now is clearly that there are two things that are happening. A, you have a much better view or much more positive view as far as the medium term shape of things are concerned. So whether it is in terms of growth, improving credit profile, etc., you have a better view now than what was the case for a better part of the last 3 years. Second, in the changing scheme of things, you will have more and more class of investors, whether it is mutual funds, insurance companies, etc., who are looking at slightly longer tenor assets compared to what was the requirement earlier. So from your perspective, if you look at the investor psyche and the investor profile now the investor is more than willing to look at slightly longer term exposures than what was the case in the last 3 years. So I guess things will be better for you from that perspective. But quite frankly, if you ask me, because this is not only your problem, this is a problem that, for example, all infrastructure companies face. That you don't have too many long-term investors other than banks who are funding them from a credit risk perspective as well, who are looking at that kind of a duration risk. The point is you have to devise, and this is for the system as a whole, you have to devise a mechanism wherein you can segregate credit risk from duration risk. There has to be some guy who is willing to do that. And if he takes out the credit risk from the proposition, there are hundreds of investors who are willing to take long-term exposures. It's actually this dichotomy that you can't have the same guy always taking both the risks, because regulatorily investors are not suited to do that in India. That is why you have this issue. So you have provident funds willing to give you 20-year money, but they don't have the risk appetite to do so. So I think that is the dilemma here, but I presume that things are going to get better from here for two reasons. A, that things are looking up as far as the economy is concerned, so people will be much more open to go down the credit curve and lend slightly longer term. So instead of getting 1-2 year money, you will see more 3 and 5 year money flowing in. But if you're talking about 10 and 15 year kind of a money, really people like mutual funds, etc., don't today have the visibility to lend that long term from a liability profile perspective.
So in the interest of time, we have to end here the session here, but I think one thing is quite clear: we are in a much stronger position. India in particular has done the right things. I mean, they started doing the right things about a year and a half back, and we are seeing the results of that. There is a sense of positivity. On the rating side also, I mean, things are looking better. So I think all of us, when we go back home, we are more excited and happy with the information which we have learned today. So I would like to thank the panelists for their insights, and I'm sure some of the suggestions will probably get implemented at some point, and which will be good for the economy and the markets as well. And I would also want to thank the organizers for having chosen this very important theme of financial markets, which kind of is being discussed all over. So thank you.
Thank you, panelists. I'd like to now request Mr. Ari Lehavi, accompanied by Mr. Aditya Gadge, to kindly felicitate our panelists. Can we have a group photograph, please? All right, ladies and gentlemen, there was EduPristine, one of our partners, who's also put up a stall here, had a lucky draw, and there are 3 people whom they would like to felicitate with some gifts. There's Mr. Chetan from Sindham College, Dr. Praveena Mule from Ashoka Education Foundation, and Nishant Gupta from NISM. I'd request them to kindly visit the EduPristine stall and collect their hampers. Also, thank you so much, each one of you, all the sponsors, the partners, and the associated staff for making the event a success. We believe the day was fruitful for each one of you, and we look forward to seeing you next year at the Credit Summit India 2015. Thank you, ladies and gentlemen. I hope you had a fulfilling day. Thank you.